Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set your agenda. Volatility recedes. Risk finds its footing for now as global turmoil drives U.S. money market assets to all-time highs. Not so fast. Governor Michelle Bowman sees upside inflation risk as markets kick off a big week for economic data. And Republican nominee Trump gears up for an interview with Elon Musk, while Democratic nominee Harris leads the former president in the three King swing states. They will be the definition of triumph in this election. There was a wholesale ransacking of risk this time last week. There was an implosion globally, from Japan to the United States of America, and the markets were baying for short, sharp cuts from the Federal Reserve. Here we are, 6 trading days later. This is how we look at the moment, flat on the S&P, but you had some of the most virulent, the best days and the worst days in stocks of 2024. The S&P at the bottom of your screen, 53.71, 50-50 held, the 200-day moving average held. That is the brick in the wall for the technicians. Morgan Stanley this morning are saying you're going to see a bandwidth trade on the S&P 500 between 5,000 and 5,400. That is only 1% on the upside, and that is 6% on the downside. Where we are with bonds, it was a near 36 basis point move from the low to the high. We are incrementally seeing yields drop ever so slightly this Monday morning. Torsten Slok over at Apollo says the Fed pricing is wrong. The Fed pricing is wrong. We're in the same mistake zone that we were at the start of the year. Again, we're counting down to CPI, PPI, and retail sales. CPI will be the very definition of where we are. Dollar yen, I put it there for the board because, again, the epicenter of everything. That's our story today. The epicenter of everything is dollar yen. A week ago, the Nikkei, just look at the bottom of your screen, had its biggest sell-off since 1987. The question you need to ask yourself is whether the trajectory for the dollar, this is really the correct trajectory for the dollar in the dollar-yen trade. I can tell you this, the short bets against the yen, they're now the least since 2023. Sonja Marten is joining me now. We're going to debate just how much of a washout there's been in the carry trade. But in the meantime, let's bring in our cross-asset strategist, Ven Ram. I'm talking about treasuries. We're waiting for the CPI this week, Ven. When you look at the wholesale ransacking of risk that we had this time last week, how positioned is this bond market? Good morning.
Morning, Manus. I think that the markets have overlatched onto the idea that, the Fed is going to cut rates immediately. They are not going to come out and do an emergency rate cut. That much is clearly out of the question. Now, treasuries, the correction in treasuries is running as we speak, and I think that treasury yields are going to go higher in the short term, because what the markets are pricing in, or still pricing in, 100 basis points of rate cuts from the Fed by the end of the year. I think they are smoking something that they shouldn't be, and I think that that correction is going to means that Treasury yields are going to head higher. Where does that leave us? On the 2-year, possibly at 420 in the short term.
Okay, I mean, that's an accusation to the bond traders that they're smoking something that they shouldn't be. But on a slightly more serious note, there seems to be this very uneasy calm, some of the best days and the worst days of this year in the equity markets, the turnaround in the bond market. Do you think that the sell-off is done for now?
Well, I mean, these tend to happen in waves, Manus, and I think that, it's useful to go back to the pre-2008 financial crisis, when pretty much the central assumption underpinning the humongous rally around that point was that home prices in the US will always keep heading higher. Of course, that movie didn't go to script. We know how that ended, with Bear Stearns and a whole lot of other financial institutions going belly up. Now, we are not nearly in the same situation in terms of how dire the economy is, but the markets are again latching on to this idea that come what may, stocks will rebound. And I think that's a fallacy. Why is that a fallacy? Because the Bank of Japan is going to normalize rates, no matter what the deputy governor said last week. And the Fed is also going to cut rates sooner rather than later. If you combine those two together, it means that the carry trade is less attractive than it was ever before in the cycle, and that only means volatility for the markets.
Yep, it's just a question of how long can dollar yen sustain itself above the 140, 142 level, Ben. A lot of people are making the fair value call way lower than that. Ben, thank you very much for setting the agenda on risk this Monday morning. My guest today is Sonja Marten, DZ Bank, weighing in on these lingering risks in markets. She writes this: thankfully, markets have calmed down a bit, but the peace seems fragile, especially with a view to the situation in the Middle East, which continues to hover over us as a massive, incalculable risk factor. Sonja, good morning. We'll come back to the Middle East in just a moment, and I understand how incalculable that is, because we just simply don't know what the response from Iran will be and where that goes. But let's focus on the narrative. A week ago, there was a wholesale ransacking of risk. It triggered a Bank of Japan verbal put, and there's this uneasy calm that has come to bear. How uneasy is this calm, and how reliable is that verbal intervention from the BOJ for now?
Well, I mean, the BOJ obviously had a bit of an issue. So for the first time in what seems like forever, they actually made a really gutsy move, and they exceeded market expectations. They delivered a hawkish press conference. And then, of course, last Monday happened, and they were, obviously very nervous after this. And we have, as you said, had comments since trying to calm things down. But the forward guidance of the Bank of Japan is clear. They will continue to hike rates. It's just going to be a matter of timing. And obviously, they don't want to encourage further market turbulence. And also, I think one of the concerns will be the exchange rate. It was way too weak some weeks ago. Rapid appreciation is also not in their interest. And of course, a stronger yen, not a strong yen, it's still a weak currency, but a stronger yen does imply a monetary tightening. So they'll be watching that. There'll be more rate hikes, but the timing may have been delayed a bit now, given what's been going on.
Well, we still got a 30% probability of a hike in November. So if the trajectory for the Bank of Japan is inexorably higher, that presumably means there is a fundamental move that dollar yen retraces back towards the 140 level, and we're not moving in that direction at the moment. So it's not going to be lockstep, is it?
No, it's not. As you've just mentioned, I think the market was massively long dollar yen, and what we have seen is a significant unwinding of those positions. We are now back in neutral territory. We were at 180,000 contracts on the CME just some weeks ago. It is now down to 11. So that's been a massive unwinding. That's obviously been a major driver in dollar yen in recent weeks. With that out of the way, the BOJ message digested, obviously the momentum is going to slow down. And I think it's going to be much more data dependent. It will depend on what's happening in the US with rates on the dollar. So I think it's, it was a one-way street up. It was a one-way street down for a brief period of time. Now, I think it's going to be more of a volatile sideways movement with a tendency lower. But, I think we have seen the lion's share of the move for now.
Let's just square it away on yen. Where are you targeting in the medium term? Does it break the 140, that sort of big blockbuster number, that 140 level, anytime soon? Or does it take another hike from the Bank of Japan to make that come true?
I think it will probably take another hike from the Bank of Japan, and it may even take more than that. I think ultimately the size of the move in dollar yen will also very much depend on what's happening in the US, because it is the interest rate differential which has really been driving this currency pair. When you take aside that brief moment where we were driven almost entirely by speculative trading, so that has been removed. So now we're back to interest rate differentials, and that will depend on the Fed just as much as it will depend on the BOJ.
We've got a lot to get through in the next couple of minutes, so let's just square away the Fed. I like what Torsten Slok said this morning or over the weekend, and he's talking about the Atlanta Fed, GDP 2.9%, Dallas Fed 2.2%. He says the market is wrong. The market is wrong. The Fed pricing is wrong. The market is making the same mistake it made at the start of the year. And if you look at the volatility last week, 150 basis points of a cut, inter-Fed meeting cut. None of that has come to pass. We've now repriced all of that again. How wrong is the pricing in the Fed at the moment at 4 cuts and change?
I think it's still wrong. Obviously, I have to sort of eat my hat a little bit. We did expect the Fed to have the luxury to wait with rate cuts until after the election. It now seems they'll have to move before that, so September. But up to 5 cuts by the end of the year with only 3 meetings to go. That seemed, massively excessive. And even now, we're still at 100 basis points. I still think that is too much because that is assuming that there'll be a 50-point rate cut at some point, which I just don't see the need for. And I do agree with what you just said. The market massively overreacted and it completely priced the Fed wrong. But it's obviously going to take a bit of time for this to be priced out. We're looking for the CPI data this week, Jackson Hole next week, and we may need to see some more data, especially the next labor market report, for that to actually be removed from the market pricing.
Well, Michelle Bowman, I think, is laying some of the hawks table, isn't it? Which is, I'm not at all convinced that now is the time to talk about cuts. She says, I will remain cautious in my approach, considering the adjustments to the current stance of policy. So again, I think we're going to get a little bit more Fed speak, and on the road, the bumpy road to Jackson Hole, it's going to be perhaps the hawks that will still be in there. You talked about the incalculable risks of the Middle East. I think that is a very cogent description of where we are. My question to you would be this. I looked at Euro-Swiss, obviously Swiss making a decade high, and there's more cuts to come from Switzerland. But is Swiss more my haven than yen, given the proclivity of the Bank of Japan to not tolerate excessive levels of volatility? So in this times of political crisis, is Swiss undeniably ground zero for haven, or do the bond market really challenge the FX market for hedge haven?
Well, if you look at what's happened in the Swiss franc, I mean, there was definitely a speculation that the SNB was in the market recently with the Swiss franc appreciating. So I think you cannot dismiss the risk here as well. I mean, the SNB has absolutely no interest in a very strong appreciation of the franc. Inflation in Switzerland is quite low at the moment. I think the latest reading was around 1.3%. So they do not want a stronger currency. So I think as well here, you have to consider the risk that the central bank will intervene or has already intervened. They haven't confirmed it so far. So I think they're both attractive, but also don't dismiss the dollar. I mean, we haven't seen a safe haven flight into the dollar because it was, the whole rate cut story was everywhere. But ultimately, in times of crisis, the dollar has always worked at a safe haven. And I think it would do the same again were things to escalate.
What's going to drive the flow? I get the feeling even from the news flow, the story flow, it's as if, never mind the hedge funds have gone to the Hamptons, I think literally everybody has decamped to the south of France, the Hamptons. I'm here, Danny's here, a few of us are still here. But from a flow perspective, and this goes back to the frivolity of markets. From a flow perspective, what can you tell me as we start out the week, counting down to CPI, counting down to retail sales?
Well, I mean, we all know that August tends to be a market in which, we could see massive volatility simply because the liquidity does tend to be lower. And I think this complete overreaction, panic move, I might say, last week kind of goes to prove that. The problem is also that central banks have been emphasizing very much they are acting very data dependent these days. So what that does is, in addition to maybe thinner liquidity, we are seeing a lot of investors sort of trading from one data point to the next. And that does also create additional volatility.
Yep, it's certainly going to be volatile. And yet on Friday, I had JPMorgan with me, and they were talking about a 50 basis point cut back to back in September and November. And you just go, wow, I mean, that is chunky. We're going to debate this for quite some time. As you're right, we're going to be very data dependent. Sonja, thank you so much. Setting the agenda on risk this Monday morning, Sonja Marten of DZ Bank. It's Bloomberg Brief. I'm Manny Scranney in New York. The billionaire owner of X, Elon Musk, said in a post that would have a live conversation with the Republican nominee for President Donald Trump. Live tonight, 8 p.m. Eastern on the platform. Musk put this on X. I'm going to do some system scaling tests tonight and tomorrow in advance of the conversation with @real Donald Trump. And of course, Donald Trump was bounced off X, Twitter, suspended in 2021. There's irony for you. Derek Wallbank is with me, our Bloomberg editor. Derek, good to see you. Here we go. It's going to be a very interesting, no-holds-barred conversation between Trump and Elon Musk. suitable bedfellows. They believe in the same thing. What do you think we're going to get from here? We had an hour's freewheeling at Mar-a-Lago on Friday. What do you think we get tonight from Donald Trump and Elon Musk?
Well, Menace, I think it's going to be really interesting. And part of the thing I think is going to be really interesting is that this is going to be Donald Trump in a very large space with a very friendly interrogator, right? Elon Musk is in Trump's corner in this election. He has had a lot of nice things to say about Donald Trump, many not so nice things to say about Kamala Harris, right? So it's very clear which way he wants these things to go. That's an interesting test for Trump, actually, because sometimes you can be a little bit more guarded with questioners who maybe you think are slightly adversarial or who at the very least are not on your side. Maybe you can let your guard a little bit down more with people who you think are on your side. So that's point one. Point two is that you get somebody like Elon Musk or anybody, you know, who's got a big platform who might be a little unconventional. I'm thinking like your Joe Rogans, your Logan Pauls, your people like that. Those sorts of interviews tend to go into different subjects than we tend to hear about, you know, on your typical Sunday morning political talk show, right? So there's a great chance that we're going to talk about some things that we don't usually talk about, and that it might be in a space where Trump might, you know, think that he's in safer hands, but with a whole bunch of people watching, not just an audience on the right.
Well, this is where it could, you know, get really genuinely interesting in that if Donald Trump goes off script, as many people said he sort of did on Friday afternoon, taking over 40 questions in the space of an hour, that this is where, for example, you know, elections can be made or killed. We're also looking at some of the polling. It's Monday morning. We've had a weekend of coverage and a lot of dissecting of, you know, Kamala Harris, when she needs to do her sit-down interview, et cetera. But let's talk about some of the polls that we have. We've got a New York Times Siena College. Now, this is August the 5th to the 9th. Harris is now at 50%. This is in some of the biggest swing states, Wisconsin, Pennsylvania, and Michigan. And that is in comparison to Trump. So there is a shift in the dial. I mean, like, this is but one poll. Financial Times also going with, you know, they seem to trust Harris more with the economy. Let's deal with the momentum. There's a shift in momentum in the polls, isn't there, Derek?
Yeah, and I think that's the right way to read it, Menace, is it's not where is this in a space of time, but where is this in a growth trajectory, right? And if you look at the Times Siena polls from before Harris became the nominee, you were seeing Donald Trump either leading or tied, and now you're seeing Harris with a slight lead in these states. And look, you know, the simple math of the Electoral College is that if you are a Democrat and you win Wisconsin, Pennsylvania, and Michigan, right, that's pretty much ball game if you can hold on to that lead. So it puts Harris into a pretty good position. It's a very different position than Joe Biden was in, right? You couple that with the fact that she's raised, what, $300 million since she became the presumptive Democratic nominee. She's had tons of volunteers come onto the campaign who weren't there so far. You're putting up a slide of, you know, prediction markets that I'm seeing there. You see that rise that's been there, and you also see a corresponding decline in the Trump trade, even including Donald Trump's own listed company, from his highs. It all speaks to the momentum.
It does indeed. And then you got the FT Michigan Ross survey saying she should break with Biden's economic policies. She can redefine herself as her own candidate away from Biden. Derek, thank you very much for making the time. We appreciate it. Derek Wallbank on politics. Good morning from New York. From our global headquarters in New York, I'm Menace Crenny. Let's set your agenda this Monday. Volatility recedes. Risk finds its footing for now as global turmoil drives U.S. money market assets to all-time highs. Not so fast. Fed Governor Michelle Bowman sees upside inflation risk as markets kick off a big week of economic data. And Republican nominee Trump gears up for an interview with Elon Musk, while the Democratic nominee Harris leads the former president in 3 swing states. A very good morning to you. How do you feel? 1 week later, there was a wholesale ransacking of risk. you had probably some of the best and the worst days in these equity markets of 2025. The key brick in the wall for S&P 500, 53.75 is where it is now. It never made it into that correction territory as the NASDAQ did, is 50-50, the 200-day moving average. That is the brick in the wall. We're counting down to the CPI this Wednesday. You're also seeing the largest outflows from equities since September 2023, 12 weeks of outflows. Now, you need to talk about the quality of those outflows, whether it was institutional de-risking or whether it was a much more retail outflow and perhaps risk-off narrative. But either way, these air pockets are something that Evercore Julian Emmanuel says. There are air pockets. 6,000 is still the target. When it comes to the bond market, you had a 36 basis point whip around. In the bond market, we're seeing a little bit of a drop in yields ever so slightly this morning. Torsten Slok makes it very, very clear at Apollo. Fed pricing is wrong. Market is making the same mistake as it made at the start of the year. Then you take the other side. So that's the bid side from Torsten Slok. The offer side is from JPMorgan. 2 back-to-back 50 basis point cuts. So there is a range out there. Dollar-yen you're not worried enough. If you're looking at yen, if you're looking at the dollar rising this morning by 0.5%, just a week ago, you had the Nikkei at the bottom of your screen, the biggest drop since 1987. If the Fed are cutting and the BOJ are raising, your medium-term risk in yen is to the upside. In other words, yen travels higher and the dollar travels lower. You just need to debate whether this carry trade, this gargantuan carry trade, has been taken out in size. CFTC data says the shorts are the least since the first quarter of 2023. So there has been some wholesale reduction in that risk. Last week, we saw huge swings across global markets. Equity markets on the S&P 500 logged its best and its worst one-day moves in roughly 2 years. JPMorgan's Jack Caffrey writes this. When you look back on the trading of the past week, we are most likely to realize that what we experienced was lots of noise and not much actual signal. Jack joins me around the desk this morning. So you're right. I mean, the spike in volatility, the wholesale ransacking of risk that took place this time a week ago, I'm amazed we're as sure-footed as we are at the start of this week.
Well, I think we come back through when we look at some of the economic data. In the U.S., at least, it remains somewhat robust. You look through, say, the Atlanta GDP now, it's still printing to 2.8% real GDP in the United States. Inflation perhaps slowing more slowly than the Fed would like, than the bond market would like, than some of my colleagues might like to think. But the travel is in the right direction. So I think you come through that. Earnings emerged fairly okay. The nice news right now, the corporate buyback window reopens with earnings being over. So you can actually start putting something of a bid back into the market. And I think things are okay. More volatile, perhaps, than they were a week and a half ago, but okay overall.
So it's not fair to put asset management against the bank, but let's put the context around it. I was caught up with your colleagues in the bank side, and it was 50 basis points in September, 50 basis points in November. How important is that to the floor? If you talk about buybacks, Manus will give me a bit of a floor. Earnings are a floor. GDP is grand. So how important is it that this cutting cycle begins and it goes in that kind of rapidity and size?
Yeah, I think if you tell me that you're going to see 250s in short order, you come back to that second order question. What is the Fed suddenly seeing? What data do they have that we do not see on a real-time basis? And I think if I can wind back the clock, wish I had that time machine that I could have been able to do that more successfully. But on Wednesday, the Fed offered a speech in which they said, we're going to cut, but not yet. And then suddenly the market, I think, was shaken by the initial claims data on Thursday, the jobs report on Friday. Conceivably, the Fed might have had, maybe not the absolute levels of data, but had some read on what that data might have looked like. And they were calm enough to say, we're going to stick with our plan. In their mind, to the bond market, keep calm, and we're going to move on. But if you suddenly start talking about 50 basis point cuts in rapid succession, you're thinking we really are much behind the curve and there's something in a bigger crack coming.
So I look at some flows. I look at the money market flows. I'm not surprised to see that sort of rush of money into money markets. We're at peak. We're at a real sort of high, you're still able to get money market funds paying you 5.25. So I kind of understand that, a protective moment. But then I want to talk to you about the outflows. The largest outflows since September 2023, 12 weeks of outflows. Now, you could say that we were shaken in July, but there was the big rotation move into the Russell. So there were a number of different facets at play. That kind of flow, what does that indicate to you?
I think it speaks to the skittishness that so many investors wind up experiencing right now. And that, I was a sell-side strategist earlier in my career. To some extent, one likes to lean into, I need to say something provocative to stand out from the crowd. Raising a recession forecast from 25% to 35%. Lies, damn lies, and statistics. It's a 40% increase in my recession probability. That's a provocative headline, much less so than saying my base case remains an expansive economy. So if you anchor off of the most recent data point, if you anchor off the loudest voice in the room, I can see where people say, I don't know where the world's going, I want to cut risk. I would prefer to take the tack of thinking, look at the major trend, try to stay long that major trend, and where I'll come back to is let's look to quality and try to anchor on quality that I think can power through the broader picture issues, the longer term trends, and might accept some day-to-day, week-to-week, and sometimes even year-to-year volatility on that volatility.
I mean, this is highly idiosyncratic. I had some lunch with somebody yesterday, and every day last week was, should I pair my NVIDIA risk? Should I pair my Mag 7 exposure? I said, ring your broker. Don't speak to me. I'm not the right judge of that, and I won't do that job again. But here's the thing. Yesterday, the sentence that came from that person, which was, I'm prepared to stay in and stay long because I don't think the generic AI narrative is going back in the bottle. So there was a stoicism and a resolute stoicism after 5 days of huge volatility. And I just wonder, I know that's one conversation, but I think that's a pretty good example of where we are.
You remind me right now of the Gartner model of technology adoption. You have tremendous enthusiasm, then you have the valley of despair when you start questioning, this technology will pay off as quickly as we think, and then ultimately people figure out how to make money off of it, and that's when the real fortunes wind up being made. NVIDIA up 100% up 100% as of this morning, year to date, after pulling back 20-odd% in the prior month. I like analogies. I was not great enough at math, so I'll go back to historic analogies.
Please do.
When you learn to sail, one of the first things they talk about is when do you put a reef knot on your sail? And that's that ability to control the sail under. When you find yourself being scared, you're going to be overpowered by the wind. And the example is you put the reef knot in when the sea is calm because you've actually thought about it. And you're not asking yourself to make logical decisions under extreme stress. So the idea, should you diversify a portfolio? Yes. Should you do it in the middle of a market meltdown? Harder to do because that's when emotions are probably going to be trumping logical brain. Looking at AI, I think the AI story is incredible, but right now what we're finding is how do you actually make money off of AI? And that's where the story remains a little bit softer in the shorter term, and where I think people can come back to whether I should be fully invested in AI, largely invested in AI, and that's the magic at the moment of trying to understand what's going on.
Can I square away in 30 seconds for you? When these cuts, if and when these cuts come, I read lots of research that says, look, I want to be long NASDAQ, small caps and consumer staples. Is that the diversity? I mean, consumer staples are under a lot of pressure at the moment.
Yeah, they are, because the dollar has been so strong for most of this year, and most U.S. consumer staple companies are global consumer stories now, not U.S. consumer stories. And so that, I think looking through, healthcare has been a much more stable place. Certainly right now, you've got a lot more volatility around the election coming through healthcare. Is it good for Medicare? Is it good for Medicaid? Is it good for payers? But, those stocks are much cheaper than consumer staples.
Jack, thank you so much. Getting up early, joining us around the desk, that is Jack Caffrey of JPMorgan Asset Management. On the markets, stay calm and reflect. Context matters every morning on Bloomberg. Good morning from a beautiful New York. It's your Monday edition of Bloomberg Brief. I'm Manus Cranny in New York. Welcome to the show. The risks are abound in markets, and we are bracing for a week of full economic data. On the geopolitical front, Israel boosts its critical infrastructure amid heightened risk of attacks from Iran. Now, this as Iran reiterates determination to punish Israel for last month's killing of the top Hamas leader in Tehran. The Iranian Foreign Ministry releasing a statement on Sunday writing this: Iran will make Israel's violations costly for the transgressive regime in a legitimate and resolute manner. We need to put context around that. Bobby Ghosh joins me around the table. I mean, this is what it comes down to. It's the scale and the calibration of response from Iran and the proxies. People are saying to me it's going to be a multi-pronged attack from all of the proxies as well as Iran. What are you hearing?
That is the most likely scenario. We have to remind ourselves that in April, the last time Iran felt a great provocation when Israel took out a major Iranian commander in Syria, Iran's response was directly from Iranian soil. The first time that had happened, a Rubicon was crossed. So having done that, Iran now will feel pressured to raise the bar just enough that it doesn't become a sort of casus belli. This doesn't become a all-out war in the region. But it has to do more than it did in April, but it can't do so much that it creates a war. And the most logical conclusion is it does what it did in April, plus have its proxies attack from several different fronts. So you have a multi-pronged attack, a large single attack on Israel, and then you hope that Israel's allies restrain Israel from launching into a full-scale war. The problem is not that anybody wants war. None of the parties actually want a war right now. The trouble is that the situation has now reached a level of tension that it is all too easy for one or several parties to blunder into a war. That's the biggest thing.
Netanyahu have the capacity to blunder into war. He's prepared for defense as well as offense, to quote Netanyahu.
Well, yes, he has that reckless streak in him, as well as the possibility of blundering into one. He's very confident, not only in his own military forces, but he's very confident that the United States will give him all the support that he needs, military support as well. He's not really hearing different on that score from the Biden administration. Biden administration is cautioning restraint, but at the same time providing military hardware.
The political landscape is changing here in the United States of America as well. The verbiage, the narrative, one could say the political regime that Netanyahu has had cover from here is going to change. One way or the other. You're either going to have Kamala Harris along with Walz or Trump in the White House. So there is a window here of time that this war, as various papers have said, will recalibrate. New York Times, 10 months. A low-grade war is underway between Israel and Lebanon at the border that began with Hezbollah. So this is a window that is closing for Netanyahu, isn't it?
We think that, but Netanyahu has always counted on bipartisan support in this country. He's always been, remember, he came and spoke to both houses of Congress, and he spoke to both sides. He didn't get a chance to meet directly with President Biden, but he did go and speak to Trump, and he spoke to many of the Democratic leaders. He has always calculated that no matter who's in charge in the White House, there's enough bipartisan support for Israel in the American political landscape that he can count on the United States having his back. As I was saying, the Biden administration has been counseling restraint, but he's not listening to the words. He's looking at the actions. The actions show that the Biden administration will have his back should push comes to shove. The Biden administration is sending a nuclear submarine, is sending a naval attack group to the region, continues to supply weapons. So for all the words that he's hearing, whether it's from Biden, from Kamala Harris, from Donald Trump, he believes that America will be there when he needs it to be.
Bobby, thank you very much. Let's see how this week plays. Bobby Ghosh there with the very latest. Turning our attention to the big risks in markets. Sonali Basak sits down and catches up with a finance veteran, asking them what the next big risk is for markets. Here's some of that conversation with the Oaktree Capital co-CEO, Armen Panossian.
The biggest risk that I see with respect to the markets and to society in particular is artificial intelligence. Artificial intelligence clearly has the potential for very large economic gains, revenue increases, cost efficiencies, and that investment opportunity is really exciting. It's easy to disregard the societal impacts of those same efficiency gains. What happens to normal jobs that are become obsolete because of artificial intelligence? Think of cashiers or drivers. As artificial intelligence becomes a real alternative to physical labor in some of those areas, millions of people could be out of jobs. So who's going to retrain those people? Because if we don't figure that out, that there will be social unrest, or there could be social unrest because of joblessness. In terms of the markets, artificial intelligence clearly is getting a lot of support from the markets. But just like the internet in the late 90s, there was this promise of revenues growing rapidly. While the gains are clear to see in terms of their potential, the timing of them is impossible enough. And if that timing takes a lot longer than investors expect, I would expect to see pretty violent resetting of valuations and potentially some losses for investors along the way.
What does this look like for an investor who's keeping a close eye on the economy, the job market, let alone investing in AI itself? It seems like the risk you're outlining here could impact many markets.
The attractive part of it and the scary part of it is that there isn't a monopoly on intellect that could be used to develop artificial intelligence technologies. There is a shortage of semiconductors and chips, but artificial intelligence allows economies and countries, and potentially those adverse to the US, to develop certain technologies and skills through artificial intelligence that could be problematic from a geopolitical standpoint. In terms of what investors should be looking at from the economy, it's hard to really have a leading indicator. I think, unfortunately, from the job market perspective, we're going to be looking in the rearview mirror probably after it's too late. So it's really hard to kind of pinpoint what economic indicators we should be looking for.
How do you think about this in terms of how people are behaving right now? Do you think most investors out there are ignoring these risks?
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Co-CEO Armin Panosian. On the risks posed by AI over-exuberance, Sonali is with me around the desk. Great interview. Very, very timely. He talks about a violent resetting in valuations, and that's maybe in the overall perspective of the AI trade. But I think he raises some big issues about universal income, the risks of replacing jobs. Everybody wants us to believe that AI is a wonderful boost for us, but there are real risks with it as well.
How often do you and I sit here, and many investors that we speak to really say that, oh, it'll replace some jobs, but it will make more jobs. Now we have another investor over at Oaktree saying, no, well, wait a minute. There could be a really massive impact here on the job market, not only violent resettings and valuations, of course, potentially companies that going bust, but also jobs being replaced. And of course, we know many investors watch the economic environment, but really his comment was more of a social one, and this worry about social unrest that could be created as a result of the AI boom. Now, I would say we give these investors a time horizon. We say, looking over the next 5 to 10 years, what are you most concerned about that investors are maybe not looking to? We ask twice a year. And so this, I've got to say, in the 5 years that we've been doing this project, AI is the first time this has really come up.
I mean, we're just trying to get to know him, and so this is a great window into a new leader there. Where does Oaktree's big opportunity come in this?
Well, remember, one thing I found fascinating about this was he did those 1990 comparisons, right?
Yeah.
The other thing, too, is Oaktree is a big distressed investor. So one thing they are doing is, while they are trying to get into this big opportunity in AI right now, they're looking for that valuation reset. They are thinking about that distressed opportunity already on the other side. I think that is a unique window as well, because remember, Oaktree has traditionally been involved in credit markets, but of course, a lot of these big credit funds have been doing a lot more hybrid strategies. They're waiting for that valuation reset.
You also caught up with Ann Walsh over at Guggenheim. I'm curious to see where she was on this whole perspective after a week of pretty turbulent markets.
Yeah, it's interesting. So what she's more concerned about, she says that she thinks we are still in this COVID era reset. This world where we're still feeding off of a lot of those COVID era policies that are contributing to inflation underneath the surface and contributing to that debt load that everyone is so worried about. She's worried about a black swan event that could finally set that debt load off course.
Okay, grey swans that morph into black swans. Shonali, thank you very much. Shonali Basak, thank you for joining us. Coming up, a big week for economic data. You've got retail sales. You've undeniably got the most important one, which is CPI, and that will be pivotal to the bond market in the middle of the week. Context Matters from New York every morning. Good morning. How does your week ahead look? Let's frame it up for you. Elon Musk interviews the Republican nominee Trump, 8 p.m. Eastern Time tonight. That will be broad, wide-ranging. Let's see what the headlines are. Tuesday, PPI. Wednesday, CPI. Retail sales. Thursday, trifecta of data. Home Depot, have you been shopping? We'll find out on Tuesday, and Walmart on Thursday. So big retail week. A couple of stocks to keep an eye on. Starbucks, activist investor from Starboard Value, taking a stake, according to the Journal. Qualcomm cut to peer perform by Wolf Research. And Coinbase, Robinhood are among a few firms tallying customers' crypto, their balance sheets.